So I call Martin Koch and Per Bengtsson to come here to the panel, please. Eleni Choidas could not be with us today. She has had a cold for 2 days, so she cannot even speak. So no, you can sit here, please. Sit here because you're only three of you. Go the other side. Okay, so Martin Koch, you're a policy officer at the European Commission's Directorate-General for Financial Stability, Financial Services and Capital Markets Union, which is called FISMA, usually Unit B2 Sustainable Finance. So, what are your first comments on these recommendations? You have 5 minutes. Thank you.
Good, does it work? Well, good afternoon. Thank you for the invitation. I listened very carefully because I didn't read your report. It came in yesterday, 75 pages. I wasn't able to read it overnight.
You had a short version.
I will do it exactly next week. Maybe a couple of comments before I go to some of the details you mentioned. I mean, I think we have come a long way already. I mean, if you look at where we come from, where we are and where we would like to go, we are working on sustainable finance in a systematic way for more or less 3.5 years. If you look what we have achieved in the last 3.5 years, where we come from, that's a lot. We have an action plan in place since March 2018, 2 years ago, with 10 actions. They are all under implementation at different speed, but they are all being implemented, and it takes a bit of time to work things out. If I give an example, the EU taxonomy, which means nothing else than a common understanding what is environmentally sustainable, sounds easy, but it's not easy at all. If you look at the work going into that, on the legal side and on the technical side, it takes time to put this together. It's not done overnight. And there's a lot of discussion of what should be in a taxonomy, what not. It's not yet there. It's under preparation on the technical side. And we had 6 objectives in total, and we're working on climate, not because we wanted to not work on the others, but it takes time. So we do it in a staged way. We have to do it profoundly, evidence-based, science-based, and it takes time. And we need to have the time to have a robust system in place, and that doesn't come overnight. The same for disclosures for the financial sector. There's a regulation out there, will be applied in 2021. Markets need to get used to that. I mean, it's new territory for them, and we also have to see what is meaningful data coming out of this. The same for companies, non-financial reporting directive. We have 6,000 companies in Europe doing that. We have to see what meaningful data comes out of that, and we are now revising it and see whether we can enlarge the scope. What I want to say is there's a lot of action going on. It takes time to put it together in a meaningful way, and it has to be also robust, and that takes time. Let me mention one thing which you also mentioned in your summary is what I see and what we already feel is through the European Green Deal, even if it doesn't provide new money, as you say, and we have to see what the negotiations will ultimately bring, is it provides new momentum. The European Green Deal is an umbrella of around 50 actions. And there are 2 actions which are really important from an investment and finance point of view. One is we are currently working out a renewed sustainable finance strategy. There will be a public consultation very soon asking stakeholders, the market, what are the missing elements in it. And one could be, for instance, that banks should be included. That's for the future, for the near future, to discuss that. The second thing is, under the European Green Deal, there's a European Green Deal investment plan. It might not have new money behind it. On the other hand, it is a big plan, of which we are part of it. So it's about finance, sustainable finance, but also investments. There's one thing which I would like to underline is, there's a big step between a taxonomy telling you what is dark green and an investment. Because what the taxonomy does ultimately is it tells you what is dark green and what has the highest impact in terms of environmental sustainability. It does not tell you whether this is an investment. To make the move from an activity to an investment, there's a big step in between, and this is decided by investors. Each and everyone decides on a project, into a company, do I invest or not? And there are many other parameters which have to be in place. Subsidies, taxation, carbon pricing, which make an investment either viable or not. So what we provide is environmental guidance, kind of navigation instrument, a compass, to lead us to those investments or those activities which have the highest impact. But then it's up to the market to take it up and invest. And we are trying to guide the market to this. So the taxonomy is not a book of investments. It's not a mandatory list. It guides those who want to invest sustainably into these applications and these projects. Nothing more, nothing less. But I think it's important because if you look where we come from, there's no common language. What is sustainable? We try to create this, and on that basis, you can move forward for products, regulation, taxation, subsidies, etc. But we have to have a common understanding what we mean by sustainability, and that's not yet there. I will leave it like this for the moment. I'm happy to go into more detail a bit later.
Just one little question, just one thing before Per can start. What about brown taxonomy? Because this is not only a recommendation I've seen here, but I've seen in European files a special issue on sustainable finance. There was someone from Natixis, so it's a bank, asking for 50 shades of brown. So.
Yes, 50 shades of green, 50 shades of brown, all nice.
Let's stop here.
Let's be realistic. I mean, in the negotiations also with Parliament and Council about taxonomy as it stands, it's quite an achievement to have this agreement. And we discussed, of course, also brown taxonomy, and the European Parliament brought it up many, many times. But if you see how much work goes into a green taxonomy, which is an incentive instrument, you just don't develop a brown taxonomy in parallel. It's just not feasible. If you want to do that, you have to do it in the same profound and concise way, evidence-based. There's one thing which I would like to say is a green taxonomy is an incentive instrument, also allowing those who are brown today to move and make the transition to become greener. If you identify brown, you might cut off certain sectors and companies immediately from financing. That's the last thing I think we should do, to be very precise.
Thank you. Now, Per Bengtsson, you're based in Stockholm, and since 2017 you're an executive advisor for sustainable finance in Nordea Bank. During 2019, you were part of the working group developing the principle for responsible banking in cooperation with the UN Environmental Programme Finance Initiative. So please tell us your first take, if you may, from a financial institution on these proposals. Thank you.
Source of all evil. Yeah, I'm a bit of a late addition to this conference. I was asked last week, but I am glad to hear, and I also received the report last night. Thank you, Jukka. But so I've been following the SMART project a little bit off and on from the sidelines, and so I have, I think, some understanding about it, and I work as an advisor in Nordea Bank, as you mentioned, and part of the work we do are following policy developments and also trying to translate policies into products and strategies for our bank. I can also say that I was not in Davos, so I'm not responsible for those quotes, and also glad to note that my bank was not on the list you showed. Not sure if that's the truth, but it was not on that list at least. So Nordea Bank is a universal bank. We are based in the Nordics. That means Norway, Sweden, Finland, and Denmark. By universal bank, I mean that we are financing all segments of society, from the largest corporations to the medium-sized corporations to one-man corporations. We have 10 million customers on the private side. We offer savings products, accounts, lending, mortgages, etc., etc. Financing houses is our biggest business. It's about half of our lending. So a little bit on that, and I'll kind of come back to that, why that is have some relevance for this. I just want to give you some sort of concrete examples here around the discussion for brown assets or a brown taxonomy. Beate mentioned policy coherence as something very important in order for us to achieve a sustainable development of our societies, and I completely agree with that. I think policy coherence is very, very key. As Martin mentioned here, now there is a flood of initiatives going on European level, in national level. We have in Sweden an initiative called Fossil Free Sweden 2045. It comprises 9 industry groups looking through how each sector will become fossil free until 2045. It's transportation, it's steel, it's agriculture, it's mining, and it's the pulp and paper industry. As you may know, the Nordics, it's particular maybe Sweden, Finland, and Norway, very base industries oriented societies with very energy intensive industries. We are relatively good fortune is that we have pretty clean electricity coming off the grid. We don't use any coal basically for producing electricity. We have hydro assets, nuclear still big part of the energy mix, renewables growing quite quickly. But looking in Sweden as an example, at the top emitters of CO2, at the top of the list is a steel company. Basically 1 or 2 industrial sites that is by far the biggest emitter of CO2 or greenhouse gases in Sweden. The second biggest emitter is a cement company, roughly a little bit less. And the third biggest emitter is a oil refinery. Those 3 sites emit as much as the entire road transport sector in Sweden. So that's a huge part of CO2 emission in Sweden. Steel and cement are not unimportant ingredients of how our economies work, and they are fairly crucial to construction, building, etc. The Swedish company that is emitting, it's SSAB. It's transparent. This is reported in our national reporting, so it's not a secret. They are working on carbon-free steel. They think this will be commercially viable in 2045, 2050. That means they will stop using coal in their steel production to use that. Cement industry is the same. They are working to use more renewable energy, but cement is globally a very, very important sector. Oh, I have a sign saying it's time up here, but I'm not finished.
Go ahead.
So just wanted to discussing brown assets and our role in society financing these assets. If we are supposed to stop lending to brown assets, it's very, very important that we understand what these brown assets are, their function in society. And also, I think regarding policy coherence, all these companies operate with the environmental permits from in the good democratically ordered permitting process. I can also mention we are a big business in Norway. In Norway, you know, it's very heavily dependent on the fossil fuels industry as a country still. I think the investments in on the Norwegian continental shelf is about 5 times the total investments in all the rest of the in Norwegian economy. Employs, I think, 6-7% directly in that sector. So we're looking at huge transitional issues here, and I think if you want banks to stop lending to these sectors, you need to be very clear about what the impacts you want to have and the consequences, intended and unintended, just stopping banks from lending. There is, regarding policy coherence, I mean, all these businesses I described are legitimate, so of course, if you want to stop these activities, then maybe those are the activities that should be regulated rather than banks stop lending to them. It seems like you're going maybe around the block to achieve what you really want to achieve, but just banks stop lending and the activities continue will not change anything in the real economy with regards to emissions, etc. We are trying to work with companies that are upfront about wanting to make the transition, that they recognize IPCC reports, recognize climate science, and making investments in their business to help with the transition. That's what we expect from our clients and customers on this. So maybe I should stop because my time is up since a lot, but we can also come back and talk maybe a little bit about risk.
Okay.
Thank you.
Thank you, Per. Is actually lending to brown assets, sustainable finance, could it be making green investments more attractive by dropping, for example, the cost of the money for them and making it higher for the brown assets?
Well, what you want to achieve is a change in the real economy, increasing the cost of borrowing or lending to the activity. If the activity continues, I think that will just be absorbed and passed on to the consumer in the end. And just increasing the cost of lending will by itself not achieve much, I think.
Jay, you have a comment? Take a microphone, please.
Yeah, I mean, I accept that point. And I want to make it clear that any sort of taxonomy would not involve banning or prohibiting lending for specific projects or anything like that. But you say that these prices would be passed on to consumers, and that is obviously the logical way to look at how the financing process will evolve. But that will potentially reduce demand at the final point and make those investments that shrink that investment class. And if corporations or businesses that you have ambitions to be more sustainable can demonstrate that any financing is to actually accelerate their transition to a more sustainable way of doing business, absolutely give them preferential rates, or give banks preferential rates, or at least don't penalise banks for lending to those projects. But I don't see necessarily the link between increasing the cost of financing for particular projects unless the end consumer or the end buyer is willing to tolerate it. So I see the process as complementary rather than, well, it'll raise prices. It'll raise prices to a market clearing point, but that might reduce demand for those sorts of projects, and that's surely what we want to achieve. You know, if you raise the cost of financing for a coal project or something else to an extent that it becomes unviable, then that could be an optimal outcome.
Martin, we are in the middle of the river. How do we reach the other side?
The green side or something else?
Not the mud, not the
Okay.
brown side.
Okay. I think we are in between, absolutely, and I described where we come from, where we are, and where we want to go in the future, in the not-so-distant future. I think what we see is that markets are cleverer than we think. And they need a regulation or stable frameworks, but they also decide on their own. And this is about giving good guidance. If I give an example, for instance, large companies which we had in our expert group 3 years ago, the high-level expert group where you also showed the report, we had, for instance, insurance companies, their pension funds, big pockets, large institutions looking ahead 20, 30, 40 years because they have obligations to be paid out pensions in 20, 30, 40 years. And they have an interest themselves to look forward to what is sustainable, because the obligations have to be met. And they were the ones pushing, not the NGOs in our expert group, for having a long-term view on this. I found this very stimulating because they do it by themselves, because they have even the best models to predict as much as you can the future. This is, I think, is very encouraging. It comes from some of the most advanced market participants themselves. We don't have to push them all the time. Regulation here and there, only if necessary. But there is a clever part of the market already. Those who anticipate the future as much as they can. What they need is guidance, political stability, frameworks which are not every 5 year reviewed, 10, 20, 30 years frameworks, which we try to give with the 2050 climate neutrality, for instance, 2030 frameworks, which indicate already clear goals what we would like to achieve in many areas. This is what the market needs, plus maybe a bit of regulation, meaning a stable framework they can rely on, and some incentives which can be related to the framework. This is how we think at the moment how it is. We don't believe so much in penalizing factors. You can do it, but we are more believing in incentivizing factors, and this is why we choose, for instance, the green taxonomy approach, to make those who are today in brown sectors, and they are willing to do so, a transition which they can manage in a reasonable time frame. It doesn't come overnight. It doesn't make sense to shut down steel and cement companies. We need them for construction. So you don't want to cut them off from finance. It doesn't make sense. But you have to push them smoothly, intelligently, in a way that they move where we want to go with them together, and they are willing to do this, many of them. It's not that they have to always resistance in the sectors. It's not true.
Are there any questions? Okay. Yes? Be short, please.
Yeah, now you have experience. Okay, Tine Klamboy. My question is very short. How about greenwashing? I mean, when you say the market doesn't need really strict regulation, we believe in incentivizing and in long-term frameworks. I think ultimately you do need quite strict criteria in the category green, lighter green, darker green, brown, browner. Otherwise, people don't know what to rely on. And then I can see someone investing from the Nordea perspective. It helps them to have clear, strict criteria. What is green? What is light green? What is dark green? And you can incentivize that with accompanying tax legislation, for instance. Can you maybe say something about that?
What's your question exactly?
To what extent the taxonomy is going to provide strict criteria for these words, green and brown and dark green and light green? Because otherwise the danger is so big that there is greenwashing.
Okay. Shortly?
Short answer, that's exactly our thinking, and it's exactly what in the proposal for the taxonomy is in the legal framework. It gives strict criteria. It will be then defined also in technical thresholds, activity by activity. That's exactly what our approach is. It will be binding in the EU 27 disclosure obligations. It will also be binding for the EU and member states when they create national labels, for instance. They have to refer to the taxonomy, and it will even be binding for a lot of companies under the non-financial reporting directive to also disclose how green they are for certain KPIs. So I think there is already a lot of regulation there. It's strict. It's a disclosure obligation, but it will give you an idea what is happening at economic activity level and in companies and in financial institutions. So I think that's the way we see it. It will be clear. It will be underpinned by technicalities, and it will evolve over time in light of innovation and development. So we will also tighten it over time if necessary and if feasible, but that's exactly the framework we have in mind.
Apparently it doesn't apply to the banks. It's not compulsory for the banks. So yes, for bank loans. So when can we expect that?
It applies to certain banks already. Those banks who have portfolio management, that's what we call financial market participants. It's a very technical term, but that's what already covers banks with that feature. It doesn't cover bank loans, but that's maybe an issue for the next strategy, which comes out in Q3 2020, so not so distant. If you want to raise the point as a stakeholder, please do so. For the time being, the banks with lending operations are not in. On the other hand, as I said, clever market participants, I mean development banks, Nordic Investment Bank, European Investment Bank, and all the others, EBRD, they already anticipated. They are in our working groups. They are connected internationally, and they also look at the taxonomy. And there are even banks who applied already now, although it's not yet there, and screen their loan portfolios as they stand in terms of are they green or not. I mean, don't underestimate there are clever people in the market who see that coming. They don't wait for the regulation in 2022. They look at it now and see, is it useful? Because you can also derive new products from that already now if you want. If you have the clients who want to invest into this, nobody forces you to wait for the regulation. You can also say, interesting market opportunity. I have a green product. I make it maybe even dark green, and I use the taxonomy if it's there. So, I mean, it's up to you.
Thank you. A question here.
Thank you. My name is Maria Jesus Muñoz, and I'm part.
Please speak in the microphone.
Oh, thank you. Well, my name is Maria Jesus Muñoz. I'm part of the SMART project. We have been working on developing tools for assessing. And my question is very technical, is for the Commission, is there a possibility to have a rating agency supported by the European Union to give to the financial systems help to be consistent with this taxonomy, to be consistent with what the Commission is promoting for the sustainable finance? Because market needs information to take decisions and need reliable information to take decisions. So with the tools that we have now, this non-financial information system that is being promoted, it's clear that it's not enough information for the financial system to take decisions. How green or how brown a company is, just to be supported.
Okay, so do we have the rating agencies on board?
We don't have a rating agency in mind which we support. That was your question. Do we need maybe to set up even a new rating agency? No. There is a work stream under the action plan on rating agencies, but this is not company rating, but this is taking into account ESG factors when rating a company as a risk factor. And some rating agencies do that. Maybe not in the way we want it, but I mean, they are doing it. It becomes more and more a risk factor, so it's seen as another risk factor. It might have to be pronounced more clearly in the future, but rating agencies do that. Some of them do that. We don't have a new rating agency in mind, which we support. I think we would work with those who are in the market, but I think it's becoming more and more a risk factor. Let me make one link to central banks. Central banks are also looking at financial risks, of course. And some of the central banks which are there, like the Dutch central bank, they don't have even in their mandate an explicit sustainability, let's say, issue somewhere in a paragraph. But they look at it already now from a risk point of view. They say ESG risks, green risks or brown risks are risks, full stop, as other risks. So you don't have to even an explicit mandate to spell it out. If you have this risk policy in place, you can do it already today. It depends on how you exercise your mandate.
Per, Beate said unsustainability is a financial risk. We just learned that pension funds are already taking that into account. What about the rest of the financial institutions?
Yes, I mean, on risk, I mean, I think where we're at now, it's since the financial crisis in 2008, 2009, there has been a tremendous amount of work done to de-risk the financial system to avoid similar crisis again. Everyone knows how disruptive that was. So for the past 10 years or so, the de-risking has taken the form of new regulations, new capital directives, new modeling and splitting of businesses and what you can and cannot do and so forth. And here it's a very interesting question here now when we talk about risk, because we are, of course, quite used to handle risk in the banking system, but it's fundamentally based on a backward-looking data. We're looking at financial reports, financial metrics from audited companies' reports. We look at statistics from default scenarios for different type of industries, what's stable and what's not stable. Oil is one example of a very historically stable cash flow business with very good credit rating, hence low risk from a financial perspective. So we have all these risk models, and I think you mentioned in your report a little bit about the internal risk-based models, which I think maybe it's not quite as easy as you suggest in your book, that it's nothing that prevents us from introducing our own green factors. It's a very complex, time-consuming process to get risk models approved by the financial supervisors. It takes years, and it's based on data, it's based on default statistics, and it's a constant iteration between us and the supervisors. So it's not that easy. So now we have starting to look at climate risk. And I think I'm not a scientist. I try to understand climate science as best as I can. I've been listening into zillions of calls around.
Did you read the IPCC report? Did you raise your hand?
Sorry? Yeah, I have. Yes, not all of it, but also other actors looking at climate scenarios, and you change parameters here and there, and you get like hundreds different outcomes on 5 degrees, 2 degrees, 1 degree, etc. And that's forward-looking scenario analysis, and that's quite different from how risks have been analyzed in the banking system in the past. So it's, in a sense, from a risk perspective, a very new animal, incorporating climate risk scenarios in your portfolio. We are looking at it and trying to get our heads around it. We're working with the Hydrological Institute. We'll do flood mapping. As I said, we are a big bank in real estate. Real estate close to water tends to be the most valuable real estate, because everybody wants to have a nice view of the ocean, but it's also the most vulnerable from a sea level rise increase. So we are looking at that for our real estate portfolio. I've seen flood maps of Denmark after a 1 meter sea level rise. It's not pretty.
No more Denmark.
Sorry?
No more Denmark.
Well, it's smaller. All the Nordic capitals are close to water. Infrastructure for our exports, etc., is dependent on harbor infrastructure. So it is a huge issue, but it's very, very hard to predict and understand and how to incorporate in models. Time is up again.
Yes, please. Take a microphone.
Sorry. Isn't the point about these risks is that in almost all dimensions they are impossible to predict? So you get obviously you get ranges of losses which could be inflicted in certain scenarios through this scenario analysis. But isn't the point that, people talk about the financial crisis an awful lot, and obviously it's still in everyone's memories, and it's the one episode which we've all lived through, if you like, and I've tried to draw lessons from. And even the risks from one housing market, amplified as they were through the shadow banking system, were of orders of magnitude which nobody could ever have predicted using a model. Now, I understand the risk modelling processes have evolved, but I view this as a category issue, in that I'm not saying there's an easy answer at all. There obviously isn't, but relying upon this scenario analysis when the potential costs in relation to climate change, at least, are so uncertain that I find that a compelling case to essentially make assumptions that the eventual losses could be ruinous, not withstandable, particularly on the path that we're on now. Because even the IPCC estimates and other estimates you see, they range from losses in global GDP from 1% to in the tens of percent. And that is not an occurrence that the financial system, however well capitalized it is, can withstand. And I'm not saying there's an answer through financial regulation, of course, but I think financial regulators need to be much more cognizant of those. There was a report last week or the week before about the green swan, Everyone's hopefully heard about the black swan of unforeseen risks which cause much more damage than had ever been anticipated. And the Bank for International Settlements produced a report, and I wrote a paper on this 2 years ago, which argued that in the face of uncertainty, you, to some extent, have to assume the worst. When you've got this broad range of estimates, and the worst estimates mean it's essentially game over. So,
Okay.
well, indeed, so then the financial system itself and financial actors have no incentive to do much about it. I'm not saying they don't, but if it's well, if the worst happens, we're all finished.
In the long run, we're all dead.
Yeah, indeed, yeah.
Somebody said.
Okay, okay. I just want to have some words on you on sustainability. The definition you mentioned, the definition of sustainability. We are going to raise that issue later in our wrap-up session, but sustainability, if I understood well from Beate, the planetary boundaries, you saw that it was also including social aspects, and here I hear green, I hear climate change, everything. But are the social aspects taken into account? It's the SDGs in the Sustainable Development Goals. There are social aspects very strongly. So how are they taken into account by sustainable finance? Briefly, and we'll stop on that.
Briefly, but I have two parts of the answer. One is at the moment we're working on climate and environmental, so the C and the E of the ESG, just because we have to start with something and we couldn't start with everything at the same time. It's just not possible. However, the S, social dimension, is already in the E and in the C, because we also look, when we define the taxonomy-relevant activities, that they are done or implemented or invested in a socially responsible way. We have a social dimension already implicitly in the E and the C. That's maybe for the short-term answer. Whether we have a mandate to look at the social taxonomy, meaning looking at socially sustainable investments, which is the logic of the E at the moment in the taxonomy. We don't have a mandate yet, but in our regulation we have just agreed with politically here, there is an opening clause in 2022 to revise this and look at it with fresh minds. It's a bit parked for the moment, I would say. It's not out of mind, but we have a step-by-step approach, and it takes really time to map this out in detail. But the S is not forgotten. It's not the most important one, because we have to see the climate as the most important one, but the S will come sooner or later, and it's already implicitly in the climate and environmental part through the social dimension of investing through that. I think that's, I don't know whether you're happy with this, but this is the reality, and we do it really in a pragmatic way, I would like to say. Thank you.
Okay, thank you for this answer, because I wanted to have someone from the Commission to say something on this, especially on finance. Thank you very much. I think we can stop this session here.